Hi, I'm Brandon Kaplan. This is a short presentation regarding whether or not the stock market is currently in a bubble, given for FinTech 534 at Duke University Pratt School of Engineering, fall 2023. So let's just go ahead and jump right into it. Is the stock market in a bubble? I say no, but I'm going to have to justify that claim. And so in order to justify that, first, we should probably answer what constitutes a market bubble, and moreover, how do we know we are in one? So simply, a market bubble is an economic cycle in which the prices of a market's underlying assets greatly exceed the fundamental value or true worth of said assets, and this precipitates a crash. If there's no crash, then it's not really a bubble. So a market bubble is made up of four key phases chronologically: the stealth phase, the awareness phase, the mania/euphoria phase, and the blow-off phase. The stealth phase comes first, and the bubble at this point has not yet truly formed. Basically, smart money, usually venture capital or speculative investors, sense the opportunity to make a profit when they determine that a rapid escalation in market prices in the future is probable. The stealth phase is considered over when the values that they assumed or speculated would rapidly escalate begin to actually rise quickly, because then it's no longer a secret. So what follows is the awareness phase, the point at which many institutional investors and fund managers begin to take notice in these rise in prices. Buying will continue, and usually here in the beginning of the awareness phase, there is a small dip where the original smart money sells or begins to sell their stake to take their profits. So after that dip, the price in a bubble will always recover, and the rise in value will then begin to garner mainstream media attention. This basically is the beginning of the mania or euphoria phase. There's major news coverage, 60-minute specials, increased topic volume on Twitter. Your retired uncle who's never purchased any stock before decides that they're going to invest because they saw it on TV. At this point, institutional investors will begin quietly selling their positions. If not, by this point, all the original smart money is usually out. The money coming in from more novice investors will continue to push up the price, and this will continue until the market reaches a peak, a price point at which the price is so unreasonable or unsustainable that clarity arrives and the blow-off phase is initiated. At this point, most buyers will have an epiphany that the situation is different than what they thought, that they're not in a new paradigm. And this will usually happen pretty quickly all around the same time. Some people will be in denial because there is a large investment that they have put into this position, but most will quickly try to sell their positions to no avail, as there are no buyers because people are anticipating prices to continue to decrease. Subsequently, prices collapse at a rate even faster than the escalation that formed the bubble in the first place. So now, how can we tell when we're in a market bubble? Really, a market bubble is like the eye of a hurricane. When you're in the midst of it, it is extremely difficult to identify that there is a storm going on around you, because in the eye of the hurricane, everything appears calm. However, there are some qualitative indicators that you might take a look at, and if you're doing a lot of research and paying close attention, then you might be able to tell a mania euphoria phase for what it is. And there are also quantitative indicators like valuation models such as PE ratio and the Shiller PE ratio and the Buffett indicator. So the PE ratio will look at price over earnings in the last 12 months. The Shiller ratio will look over price over earnings, but take a 10-year inflation adjusted average. The Buffett indicator will look at the total market cap to GDP ratio. And now these are informative and often will tell you if a market or asset is overvalued, but they can never tell the full story regarding whether there's a bubble. So because that we'll never get the full story from these valuation models, The next best thing to do, really, in my opinion, is to try to determine the probability you are in a bubble, because you'll never know for certain. So defining a crash as a 40% drawdown over a 2-year period, and this was chosen as this definition captures many famous price run-ups and their subsequent crashes over the past 100 years. Then a 100% industry net of market return being observed over a 2-year period implies that there is a 53% chance of crash. That is, it is more likely that you are in a bubble than not. Now, if that industry net of market return is even greater than 100% over 2 years, say 150%, then this would imply a near 80% chance of crash. So how deep into the weeds are we, or not? Now, it's fair to say that the stock market is currently overvalued, but again, I'm reiterating that we are not in a bubble. If we look at the Shiller PE ratio, it's at 31.1 right now, today, as of September 5th, 2023. That's 18.6% higher than the 20-year average of 26.2. Now, the Buffett indicator as of September 5th, 2023 was at 170.2%, which is roughly 1.5 standard deviations higher than the historical trend line of 121%. So both of these valuation models indicate that, yes, we are currently in the midst of an overvalued market. However, the S&P 500 2-year return as of August 31st, 2023 was down 0.33%. And as of last month, July 31st, 2023, it was only up 4.41%. And over the last year, only up 12.99%. This implies to me that we are currently in the territory of low probability of full-on crash, or 40% drawdown over 2 years. Thus, since an imminent crash is unlikely, we are not in a bubble. So what can we look for in the future? While the market is overvalued and the 10-2 Treasury yield spread is inverted, we will most likely avoid a recession in 2023. Just because the market is currently overvalued and will likely be corrected doesn't mean that it won't continue to be overvalued, at least in the short term. Much here depends on whether or not the Fed hikes or cuts rates in the coming month. So it seems probable to me that the bull market that started in June of 2023 will continue through fiscal year 2024. A way to capitalize on this would remain bullish or be bullish on big cap tech and large cap growth in the short term, but don't get too invested mentally and be wary of a cool down outside of a year's time, because the market is overvalued and it is due for a correction, just based on the growth of the S&P over the past 2 years, most likely not a full-on crash or a 40% drawdown over the subsequent 2 years. So that's my presentation, and thank you for listening.